Welcome back. About a year ago, to be precise, in October of 2015, I did a series of 4 posts on the ride-sharing business. In the first of those posts, I valued Uber, and I valued it at about $23 billion. I followed up with a valuation of Lyft, and I closed off those posts by looking ahead at the ride-sharing business. And here's what I saw. I saw a business that had grown incredibly fast, but I thought that the business model that was being constructed was not a viable one that could deliver profits in the long term. In fact, in that final post in October of 2015, I laid out 4 possible ways in which the ride-sharing business could evolve over time. The first was the possibility that there could be a winner-take-all, and Uber dominating the entire world and effectively then being able to charge whatever they wanted to the customers in that market. The second was what I call the loser's game, which is you'd have 3 or 4 big ride-sharing companies, each of whom thought that they could be the winner in this game, that they could compete with each other to the point that they could all end up as losers. The third was I drew from the mafia in the 1920s in the US, actually came to an agreement where in the face of incredible warfare among the different crime families, they decided to divide up the US into regions, and each crime family was given its own region and essentially prevented from going into the other markets. A divide and conquer approach. And I suggested that maybe this might be one possible outcome in the ride-sharing business is you could have the big ride-sharing companies, 3 or 4 of them, divide up the world and essentially take each segment of the world that was theirs and make money on that segment. And the final possibility that I saw was that somebody who's not in the game right now, a big player from outside, a Google or an Apple, come in and change the game. It's about a year later, so let's take stock as to what's happened in those 11 months. The first is ride-sharing continues to grow. It's clearly not going to stop growing. And the pace you can see pick up in the US as not only is it drawing more users who are using it more, but it's also drawing a higher percentage of the population. People who you would not have thought of as potential ride-sharing customers are now becoming customers. At the same time, it's globalizing. It's globalizing fast. In fact, the biggest growth story over the last year has not been Uber, but Didi, the Chinese ride-sharing company, which actually completed at 1.43 billion rides just in 2015. Just to give you some perspective, it took 6 years for Uber to get to its billionth ride, and Didi was able to do it just in 1 year. Ride-sharing is also getting deeper roots in India and Southeast Asia, where you're seeing ride-sharing companies there kind of be able to make inroads into fairly unconventional areas where people have not used ride-sharing before. The choices are also expanding. It's no longer just get in a car and pay the driver. You have carpools, you have competition to mass transit. Ride-sharing companies are also offering a little more flexibility. They're offering pre-scheduled rides in some cities. They're offering multiple stops on a single trip for those groups that might need to be dropped off in different places. But you can see the choices expanding, and it's quite clear that the game is unraveling for the status quo. That if you're an old-time taxi cab medallion owner or a car service operator, that if you're hoping that things will go back to the way they were, you're hoping for something that's not going to happen. The business has changed fundamentally, and disruption is here, and you can see it show up in the prices that people are willing to pay to operate a New York City cab or a Chicago cab, and this is probably being replayed in other parts of the world. The price of a New York City cab medallion has gone from $1.5 million to about $500,000. That's a 67% drop. And more than anything else, those price changes reflect what investors think about the future for the status quo. So this stage, it looks like a success story, right? A fast-growing business, ride-sharing has clearly succeeded. It's managed to disrupt car service. Now a little bit of the bad news. I think that while it's managed to disrupt the car business, it's not the business model that's been constructed by ride-sharing companies is not a viable one. And here's why I call it not a viable one. If you look at the ride-sharing companies over the last year, here's what you see. First is they're raising capital at a breathtaking pace. More than $10 billion in capital being raised collectively by the ride-sharing companies. About $7 billion by Didi, about $3.5 billion by Uber, most recently from the Saudi sovereign fund. and sundry amounts by the other ride-sharing companies. So capital continues to flow into these companies. The prices that are being attached to these companies, and notice I use the word prices, not values, because I don't think venture capitalists and investors are actually valuing these companies, are sky high. Uber's most recent pricing was $62.5 billion. Didi's up at 28 and rising. And the other companies in the space are also seeing their pricing rise as they attract capital. The capital is coming from not from traditional venture capitalists or people who traditionally invest in private business. It's coming from public investors. It's coming from mutual funds. It's coming from pension funds. It's coming from the wealth management arms of investment banks. It's even coming from sovereign funds. And while all this cash is coming in, these companies are managing to burn through this cash almost the minute they get it. Now, the cash burn, while many people are worried about it, by itself doesn't bother me, because that's a typical feature of young growth companies. You burn through cash because you're trying to grow. In fact, I would expect cash burn to be high at a young growth company. But here's the reason I'm a little troubled at the cash burn at ride-sharing companies. Here's a very simple test I run. Assume that growth comes to a standstill tomorrow, that ride-sharing stops growing. Do you think ride-sharing companies will be able to start making money if that happens? If your answer is yes, you're in a conventional growth business, because what happens is when the growth stops, you don't have to throw the cash into growth. You can start to consolidate your markets, charge the prices you want to get profits, and make money. I don't think that's true for ride sharing. I think even if growth came to a complete standstill, the nature of this business is that the competitors will eat each other up. So as you've seen, Uber tries to attract Lyft drivers by paying them $2,000 a piece. Lyft tries to attract. So the way this game is structured, I don't think that even if growth comes to a standstill, you're going to see these companies make money. And that's why I think the business model has to change. And I'm not alone. I have a feeling that this is something that many of these ride-sharing companies are seeing coming at them. And I have a feeling that we're very quickly approaching what I call a bar mitzvah moment. What's a bar mitzvah moment? When companies or startups are very young, they're judged based on metrics that investors are willing to use. And these metrics could be the number of .com visitors with .com companies, number of users of your social media company, number of riders of your ride-sharing company, on the presumption that because you're young, you can't expect the company to make money, that these metrics are what you're going to focus on. So initially, if you can increase the number of riders of your ride-sharing company, I give you a higher price. There's a point in time, though, in every young company's life where investors, for some reason, and we have no idea when the shift or why the shift happens, for some reason start to shift their focus away from the raw metrics to something more substantial. When will you be able to convert these riders into revenues and profits? That's called the bar mitzvah moment, and because it comes unpredictably, many young companies are not quite prepared for it. In the social media space, I use Twitter and Facebook as my illustrative examples of one company that was ready for the bar mitzvah moment, Facebook, and one company that hasn't, Twitter. In the ride-sharing business, we're going to find out which of these ride-sharing companies are being built up as business. And what I mean by that is the key to success in a young company is you got to manage it at two levels. One is you got to deliver the raw metrics that investors want early in the process to get the higher price. But at the same time, you got to be working on a second, almost in parallel, in terms of putting in place the places you will need for converting these metrics into profits. So when the bar mitzvah moment comes in, you're ready. You can say, this is what we have in place. Now, that bar mitzvah moment is coming, I think, for ride-sharing companies. Now, there are three reasons why I think it's imminent. The first is, when you attract money from public investors, it's a Faustian bargain. The Fidelities and the T. Rowe Prices of the world are not investing on a 10-year time horizon or to exit 3 or 5 years from now. They want to turn this around pretty quickly because they have to answer to investors in 6 months or a year. So many of these investors came in expecting an IPO to be sooner rather than later. And given that there has been no public offering in this space, they're getting a little impatient. The second is, initially at least, I think there were a few people who thought in this business that there was going to be a winner-take-all, probably Uber in this space, and they invest in Uber expecting it to be able to wipe out the competition with its capital and then charge whatever the customers would pay. That's not going to happen, and it looks less and less likely to happen because capital keeps flowing into this market, and you now have another big player in this business who's not going to go away, Didi. The third is, I think that everybody in this business is looking over their shoulder at the potential that a big player could enter the business, whether it's Apple or Google or Tesla, we don't know. But especially with Apple and Google, there is this fear that if they come in with their deep pockets and their technological edge, that they could put the ride-sharing companies at a disadvantage. So for whatever reason, I think the companies are waking up to the fact that they've got to fix their business models. And much of what we've seen in the last 11 months, I think, you can put into this framework of thinking about companies trying to build up a business model. Take, for instance, all these partnerships you've seen. Lyft with GM, Get with Volkswagen, Uber with Toyota. At one level, you're saying, well, maybe they need the capital, but they don't. They can actually raise capital a lot faster than the companies they're partnered with. But I think there's a reason for these partnerships, and one is to increase switching costs. Switching costs in what sense? I think right now the problem in ride sharing is neither your customers nor your drivers, if you're a ride sharing company, are attached to you. Your drivers for $2,000 will switch to somebody else. Your customers for a $50 discount will switch to somebody else. I think you need to create switching costs, and one way to create these switching costs is with these partnerships. For instance, Uber's partnership with Toyota is going to allow Uber drivers to get a preferential lease, a lease on much better terms from Toyota. That's good news, right, if you're a driver? The bad news, though, is once you've locked into the lease, you are connected to Uber in a way that makes it more difficult for you to leave Uber. I completely understand that rationale, and I think you're going to see more of these actions. The second is you are getting a sense that the ride-sharing companies recognize that if they keep fighting each other, it's going to be mutually assured destruction. It's especially true with the Uber decision to abandon China, it's going to be the largest ride-sharing market in the world to Didi, in return for a 20% ownership stake. And I think by doing it, Uber gets two things. One is it stops that bleeding of cash that it's had. It's estimated that in China alone, Uber was spending $500 million to $1 billion. It stops the bleeding, and maybe it'll also create a market where Uber and Didi can divvy up the market. Shades of the mafia, right? And thirdly, I think, and this is the least visible of the actions, I think ride-sharing companies, and this is happening more behind the surface than in front, are looking to see how they can increase the capital intensity of this business, making it more difficult for new people to come into the business. It's going to be tough to do because it'll mean they'll have to invest more in cars and drivers and infrastructure, but I think it's coming. So if you look at Uber and the changes in the last 12 months, here's what you see. Growth continues. The company's revenues continue to grow, although pace is starting to slow up. The biggest news, of course, is their decision to abandon China, which, as I said, is a big part of the total market. The second is their agreement to leave China did bring some good news, which is less competition with the biggest rival in this business, which presumably could create the pathway for, I won't use the word collusion because that suggests some legal problems, but less competition, maybe less cutthroat competition, perhaps higher profits. It is also bad news for the smaller players in this game, people like Ola and Grab Taxi, because Didi's invested in these companies, and the story was that Didi was investing in these companies to stop Uber, but now if Uber and Didi come to a peace agreement, then what happens to these smaller players? We'll see. Third is on the cost front, you continue to see developments that are disquieting from an investor perspective. In Seattle recently, Seattle Council passed law that allows Uber and Lyft drivers to form unions. I think that might be a precursor for other cities doing that. You continue to see fights in city after city where the ride-sharing companies are required to meet more upfront requirements. In fact, both Uber and Lyft chose to leave Austin because Austin required them to do background checks on their drivers. I have a feeling that you're going to see these in dribs and drabs across the globe, and they're all going to increase costs. Perhaps not to the level of a traditional taxi cab, but you won't see the cost advantage that you right now have as a ride-sharing company relative to the status quo. And finally, news about the imminent competition. Every day you pick up the newspaper and you see another little or a big story about either Google or Apple doing something with a self-driving car. And to add to the mix, Tesla has jumped in now, and Elon Musk has a lot on his plate already. I don't know how he's going to pull this off, but it's clear that change is coming from outside. So I decided to revalue Uber. If you remember, a year ago I valued Uber at about $23.4 billion. And with all the new information that has come out over the last year, let's see what changes I might have to make to that valuation. The first and biggest change, of course, is Uber's exit from China. And it's a trade-off. On the one hand, removing China from the equation does reduce the potential market, and I reflect that in the total market that I give Uber. But at the same time, by entering into a peace treaty with Didi, Uber has in fact potentially increased the market share it could have for the remaining market. As I see it, this is bad news for all the smaller players in the market who've been looking towards Didi as their defense against Uber. And this could potentially show up for Uber as a larger market share of a smaller market. I think the cost pressures are going to continue. In fact, I think my estimate of a 25% operating margin a year ago might be over optimistic, given how the expenses continue to be spiraling out of control. And I think that you have to reflect those changes in the valuation, and I did. And with those changes put in, the value that I get for the operating assets is about $21.4 billion. That's about $2 billion less than I got last year, but I'm not quite done. One of the things that I did not do last year, partly because I didn't have the information, is reflect how much cash on hand Uber had. And given that Uber raised about $3.5 billion just a few months ago, I would assume they haven't burned through all of it. So I'm going to give them credit for about $1.5 billion in cash. That might be a little too high, a little too low. I mean, it's not going to make a huge difference if it were $2 billion or $1 billion. The other thing I've got to bring in, which I did not have to factor in a year ago, is the fact that they now own 20% of Didi. Now, they priced this 20% at $7 billion, but that's assuming a $35 billion pricing for Didi. And if the same forces are operating in pushing up the pricing of Didi as are pushing up the price of Uber, my guess is that the value for Didi is a little lower than $35 billion. I've estimated at about $25 billion. I would have to do a full-fledged intrinsic valuation, but 20% of $25 billion is $5 billion. You bring those two changes into the mix, the value that I get for Uber today is about $28 billion. Notice that a chunk of that value is just bringing in cash, which I did not do a year ago. The other is, I think that the net trade-off from the China exit might actually be a positive one for Uber. So for the moment, that's where I am. Could that change in the next year? Of course it could. It could go up by 100%. It could drop by 50%. That said, today there are lots of institutional investors who disagree with me, whether it's Fidelity or whether it's Goldman Sachs or whether it's a Saudi sovereign fund, who estimate a value at least their pricing is more than 2 times my estimated value. What does that tell me? Well, it tells me that they must either have a better story, a bigger story for Uber, or they're pricing the company, not valuing it. But from my perspective, at $62.5 billion, the company remains overpriced. But it remains a company that I will track over the next few months because it's a fascinating story of disruption unfolding in front of us. Thank you very much for listening. I hope you enjoyed this talk.